So thanks everyone for coming to It's the End of the World, a little presentation about where we are right now in November of 2022 and where we think things might be going and some things that we might want to think about as we look forward. You know, It's the End of the World. It's really a great song written by REM. That's what we were just listening to. It came out in 1987, and it actually hit number 69 on the Billboard charts. But the really interesting thing about the song is that in March of 2020, it came back and it re-debuted on the Billboard charts at number 4. And I think the reason why is because, well, nobody knew really what was going on with the world at that time. And it was a really an apropos song for the time. And I think, I don't know, I mean, maybe it's gonna hit the charts again, or at least it will in the real estate world. I love music, and I used to actually be an actor. I always wanted to be a rock star. Was a big fan of REM, but for me, I guess I just didn't have that really cool vibe. So at the theaters where I ended up, I was a musical theater performer. I was in a bunch of musicals throughout the country. And then I started tinkering around with computers, did some computer work, and eventually started doing real estate as a hobby. About 7 years ago, I dived into doing real estate full time. I had done it as a hobby for 10 years, but 7 years ago, I started going full time, and I built out quite a portfolio when it comes to real estate. I have over 10,000 units that I've invested in as both a limited partner and as a general partner or a principal. And here on the screen, you can see all the properties that I'm a principal in or have been. We've had a few that we've actually sold since we've completed our business plans. Based on my experience in real estate, I mean, heck, I even wrote a book about it. A lot of people have been coming to me lately and asking me, hey, Matt, what do you think's going on in the world as it pertains to real estate? Like, is now a good time to be investing in real estate? Should I be sitting on the sidelines? Where are interest rates going to go? Are we in a recession? All of these really great questions. And the bottom line is I tell everybody, listen, my crystal ball, it's a bit hazy right now. I'm not really sure what's going to happen, but what I do when I'm looking at real estate and trying to figure out where things are going to go, I look at the data, the current data that we have, and I also look back at historical data. That's really my starting point as I'm trying to figure out where things are going to go in the future. As Mark Twain is famous for saying, history doesn't repeat itself, but it does rhyme. So we are not going to necessarily see exactly what we've seen in the past, but we will probably see things that are similar. So tonight I want to share 3 things with you that I think all investors should be thinking about as we move into the future. So the 3 things are mindset, interest rates, and also demand. So let's start with the first one, mindset. There are these things called biases, right? And what biases are is it is a way that we interpret the world, that we interpret data that comes in, sort of a lens that we see things through. And one of those biases, there's hundreds of them, but we're going to talk about one of them tonight, and that's recency bias. Now, what recency bias is, it basically says that we are going to put more weight on something that has happened more recently than something that has happened in the past. So when it comes to investing, we may give more weight to the events of the past 12 months versus what's happened maybe in the 5 years prior, as exemplified by this graph here. If you've had really great returns over the past 5 years, but the past 12 months maybe haven't been that great, does that really dilute the fact that the past 5 years were really good? If you average them all together, maybe the returns are really good. But if you've had a terrible 12 months, people start to wonder, hey, should I continue investing? This is something that could really skew the way that we look at things. And I want to talk about 2008. 2008 was the last real recession that we had. Technically, we had a recession for 2 months during COVID, but I don't think people really are considering that a recession. So our last recession was 2008. We saw US home prices go down. This graph here, you don't have to worry about each individual line, but if you look at the overall curve here, things went up, then they went way down. In 2008, we saw the home prices go down 15 to 20% in some places. The bottom line is that doesn't usually happen. Usually in a recession, we do see home prices go down, but it's usually around 2 to 4%. Matter of fact, there was a Newsweek article in July of this year where they were speaking with the chief economist for Redfin, and he was saying that he predicted that the next time we go into a recession, that it would probably be about a 2 to 4% reduction in home prices. There is a group called the NBER, the National Bureau of Economic Research. This group is the group that determines when we do or don't have recessions in the United States. They are a nonpartisan, nonprofit entity, and they make these declarations usually after they usually happen in the few. They're usually backwards looking when they're talking about these types of things. But looking at their data over 14 decades of the United States, we have been in a recession 30% of the time. That was a surprising thing for me when I found out. And if you go back into the mid 1800s, those recessions last on average about 17 months. And if we look at this next chart, this is very interesting. These gray vertical lines that you see here, these are all the recessions we've had since since World War II. And so each of these gray lines shows you when we've had a recession. Now, on average, these recessions have only lasted 10 months. The thing to note here is if you look after 1980, we've really only had 3 recessions in all this time. So this is what plays into sort of that recency bias. So the most recent recession we had, which was the Great Recession, was not a normal recession, doesn't mean that the next recession is going to be that way. And also in the past, 30, 40 years, we haven't really had that many recessions. So for us, a recession seems like something that we don't have. And it's like, oh no, this is a problem. But when you realize that 30% of the time, the US economy is usually in a recession, you realize that recessions are actually normal. They're part of the business cycle. They should happen. We've been lucky that they haven't happened more frequently recently, but it doesn't mean it's going to be that way. And it doesn't mean that it's necessarily such a bad thing. The next thing I want to talk about is interest rates. And interest rates and that recency bias have an interesting correlation between the two, because when you look at our 30-year mortgage average, and I think this is what a lot of people are looking at when they're looking at interest rates. They're looking back to 2010 and they're saying, okay, in 2010, we were at 5%, and then we went down, right? We've been between 3% and between 3 and 4%, but really below 3% for the past couple of years. And then if you look all the way on the right of this chart, we have this massive spike up, right? Up to 7%, okay, above 7%. So when you look at the chart this way, wow, mortgage rates, they seem unbelievably high. What's going on? We have this huge spike. This is not normal. This is not average. But actually, if we go back and we look at where interest rates have been since 1972, in 72, they were over 7.5%, and then they went way, way, way up in the 80s. Average mortgage rates are usually anywhere from 5 to 7%. So the fact that we're at 7% right now, it doesn't really, it's not that bad. Of course, recently we've been a lot lower, so there's that recency bias coming into effect. When we also talk about interest rates, one of the things that I look at is SOFR. Some of you may be familiar with this acronym, but it stands for the Secured Overnight Financing Rate. If those of you who may have heard of LIBOR, SOFR is actually now replacing LIBOR as the standard. This is a standard that a lot of financial institutions and instruments use. It's basically an overnight lending rate. And a lot of commercial real estate mortgages are actually a spread over SOFR. So a certain percentage points over SOFR is where they peg your interest rate, especially if it's a floating interest rate. When we can look at something called the SOFR forward curve. Now, what this curve is it's not necessarily a prediction of the future, but it kind of sort of is, because what it is it's a forward-looking pricing guidance that they use. This is based off of today, actually. I pulled SOFR today, the forward curve today. And this is where people are using this curve to price things like rate caps, different sort of commercial and business financing. This is all based off of this forward curve. So this can give us an indication of where the market is pricing that where rates will be in the future. So if we look at this, we can see that the SOFR curve shows us topping out on interest rates in second quarter of next year. According to this chart, and again, the chart can change every day. And I should also say, the chart isn't always 100% accurate, right? There's a way you can go online and you can search SOFR forward curve, and there are charts that will show you how accurate it was based on previous predictions, but it's usually pretty good directionally. So this is showing us topping out in the second quarter of next year with interest rates at the curve at the SOFR rate at 4.89. So interest rates would be a certain percentage above that. It might be 2%, 3%, 4% added to the 4.89. But then by November of next year, so 12 months from now, we're at 4.63. Now we've gone up from where we are right now, right? Right now we're still below 4%. A year from now, 4.63. But 12 months later, they're predicting a 1.3% drop, even lower than where we are now. So here's where we would be 2 years from now. And then we see it continuing to drop slowly, but another 30 basis points by 2015, and then going down to below 3% as we sort of bottom out right around November of 2026. So that's 4 years from now. And then as we continue out through 2033, we see a gradual increase, but it's not very, very much. So that's kind of what the markets think is going to happen. So the next 12 months, a big spike up, but then the following 12 months, they're seeing it go down and getting down below where it is now. If we look at where we are now, and then we look at this historical average, which is the blue line underneath, this historical average is based on the last 5 tightening cycles that we've had. What usually happens is the Fed raises rates to a certain point, they stop raising rates, and about 9 months after, on average, they start dropping them. So if you look at the top line, that's the forward curve that I just reviewed with you. However, the historical average actually shows, number one, it historically doesn't go up as fast as it has. The Fed's been raising the rates really quickly to fight the inflation that we've had. But also, historically, we come down quicker and we come down further than what the curve is saying. So I don't have a crystal ball, and I don't know that history is going to repeat itself, but it may rhyme, and we may see that the interest rates from the Fed are actually going to come down and come down further than what the curve is predicting. More than just coming down, people have been looking at rate caps lately, right? Everyone's been talking about rate caps, buying a rate cap. What a rate cap does is it allows you to protect from the interest rates going up too high. It's basically an insurance policy you can get that stops the interest rates at a certain level. But what's happening now is a lot of the banks are looking at actually how far down interest rates could go based on, if the Fed starts giving some relief here and maybe starts lowering rates in about 9 months. If you're a bank and you're loaning money for 3 years, 5 years, 10 years, you might be afraid that all of a sudden your interest rate's going to go way, way, way down. So what a lot of lenders are doing nowadays is they're putting a floor in. So they're saying, hey, interest rates, we're going to have a floating interest rate, and, it could go up as high as it does, but it won't go down below 3% or 4% or whatever that number is. So as investors, we should really be making sure we're taking a good look at that in our loan documents and making sure, hey, are they putting a floor in here? And how do we feel about that? Maybe we can negotiate a different term on what that floor might be, or try to find a deal that doesn't have a floor. So that's something we should all be keeping in mind as we move forward. And I want to tell you a little story about interest rates. This is all a projection, right? This SOFR curve, that's what people think is going to happen. That's what they're projecting. A lot of that is based on the information that has been given by the Fed and what the Fed is saying they're going to do with their rates. And so it reminds me of a property that I bought in 2018, Sunrise Properties. We bought in Lawrence, Kansas in August of 2018. And at the time, the Fed was telling everybody that they were going to continue raising rates throughout the rest of 2018. And they also told us that they would be raising rates at least twice in 2019. When we locked in our interest rate in August, we got a 5.1% interest rate, which is actually a very good, like historically, a really great interest rate. Not as good as, the 3% or below 3% that we've seen in recent years, but 5.1%, we were overjoyed. And we saw rates continue to rise in 2018 until around the end of the year. And then something happened. The Fed didn't actually continue to raise rates, and they actually started to lower them. Now, I know a lot of you already know that, right? In the 23 months preceding us locking in that rate, we saw the 10-year Treasury drop almost 2.5 points. So we went from, basically 2.94 was the interest rate. It was the Treasury right around the time we locked in. And you can see on this chart, it went up a little bit, and then it started going down and down and down and down. So this is an indication. And listen, yes, COVID did come into play here, but we had already dropped down to below 2% before COVID ever came around. I mean, if you look at January 2020, we were still below 2%. And then we had the big precipitous drop. So the Fed does their best to do their job and fight inflation and keep our economy healthy. And I believe that they work hard and they do their best to make their predictions on where they see things, that are the way they see things going, but they don't always know. Different things happen. That's why they meet every month and discuss and look at things and try to figure out where the economy is going and what sort of levers they need to pull to help the economy. The last thing that I want to touch on when it comes to interest rates is the correlation between interest rates and cap rates. Now, with interest rates going up, we have seen some rise in cap rates. And just as a reminder for everybody, as cap rates go up, it actually means that the real estate values are going down. There's an inverse relationship there. But as we have seen a increase, but the increases are not always lockstep. So we shouldn't be worried necessarily saying that interest rates are definitely going to push cap rates up. Now, like I said, they have pushed them up a bit, but it's not always in lockstep. And this is a look back at 1990 to 2001. And you can see the spread between that Treasury and that cap rate, it differs throughout the graph, right? We're down to, in 2005, we're at like a 200 basis point spread. And then in 2020, we're at a 540 basis point spread. That period between 2005, 2006 to around 2011, 2012, we actually saw the cap rates. The cap rates are the upper line, the thicker line up on top. So we saw cap rates go up. That red line is just showing you sort of the trend that they were doing. They were trending upwards. But the lower line, that shows the 10-year Treasury. The Treasuries were actually going down. So at this point, we saw interest rates going down, but we saw cap rates going up. And so they're not always lockstep. So just because interest rates are going up, it doesn't necessarily mean that cap rates are going to go up. Cap rates are really more a function of demand. And that's the last thing that I want us all to be thinking about is demand. Real estate is really driven by demand. It's all supply and demand. And there was a recent study done by the National Apartment Association in conjunction with the National Multifamily Housing Council. And they did this report and they saw that they're predicting anywhere from 4.8. The red line is high rentership, and that's 4.8. And the green line is low rentership, that's 2.4. So on average, they were talking about 3.5 million homes that need to be created by 2035. So this chart on the left shows thousands. That's on a yearly basis. This is tens, 20,000, 30,000 per year that need to be built based on the demographic growth that we have here in the US. We need more housing. There's a drastic need for housing. 3.5 million new houses needed in the next 13 years. So that is really, I think, what's going to drive real estate in the long term. So you really got to figure out what you want to focus on. Do you want to focus on days as an investor? I mean, look, there's people out there who are day traders who are really great and make a lot of money in the stock market trading things every day. But I tend to prefer to look at things on a longer term basis, looking at this from decades and trying to understand where do I think things are going over time, over longer periods of time, to decide where I'm going to invest. They always say, I've heard a couple of sayings around this about don't try to, it's not timing the market, but it's your time in the market. Or I've heard someone say, don't wait to invest in real estate, invest in real estate and wait. And I think that all just kind of speaks to sort of the longer term nature of this. I do think that the next 12 months, possibly up to 24 months, are going to be very volatile. We are going to see interest rates rising. And I would say that things are going to be difficult, but that doesn't mean that you can't find a really good deal right now while the market is sort of in a state of confusion and maybe panic. You could find a great opportunity. You could buy it and refinance in the future, or maybe buy something all cash and finance that later. So I do think that looking at things from a longer term perspective will do very well for investors. I have that book I mentioned earlier, Backstage Guide to Real Estate. And the book talks about my journey from knowing nothing about real estate all the way to where I am now. And I share these 18 keystone concepts that I learned along the way. And keystone concept number 5, that's cash flow is king. And what I say in there is, listen, only buy properties that generate positive cash flow. This really came from something that my dad taught me. He told me, Matt, you'll never lose money in real estate if you never have to sell. So having that cash flow, that gives you that resiliency to kind of ride out those inevitable dips that we're going to have in the market, right? There's always going to be ups and downs. 30% of the time, the US economy has been in a recession. We're going to be in another one at some point. I don't know that we're in one now. Who knows? Maybe we will, maybe we are, maybe one's coming up. If we have that cash flow and we have a little bit more of a longer term outlook, we can ride out those dips in the market and hopefully wind up in a really good place. So I wanted to leave this conversation hearkening back to the song, the REM song from earlier, right? It's the end of the world as we know it, but the rest of the lyric is, and I feel fine, right? I mean, look, things are really bad right now, but I feel okay, but I didn't feel okay with leaving with the REM song because it really only hit number 4 in the Billboard charts. So I wanted to leave us with a number 1 song, which is from 1964, I Feel Fine. So same words, but by my favorite band, the Beatles. This was number 1 on the Billboard charts for 3 weeks. So, I feel fine. And I think that you should too. And I thank you for coming tonight. I hope everyone found these 3 insights to be really helpful. And I'd like to open up now for some questions and answers from the crowd. So you can go ahead and there's a Q&A box at the bottom that you can go ahead and type in a question if you have a question, or you could type one in the chat. But if you have any questions about anything that we talked about, or anything about where we are in the market today, or where things are going, I'd love to answer any questions that you might have. So please feel free to go ahead and ask some questions. I don't see any yet, so don't be shy. Go ahead and put something in the chat or in the Q&A box, and I'll be happy to answer any questions that you might have. I see that someone's raised their hand, but the person who raised your hand, if you could type it into the chat box, if you don't mind, because being that this is a webinar, I don't think I can actually click people. Oh, here come the questions. Oh, from some heavy hitters in the real estate market. Wow. Okay, guys, I'll try to answer. I haven't read them yet, but I'm a little worried. All right. So the first one, it says, what are your thoughts on new developments versus value add in this market? That's a really great question. Thank you for asking that one. I don't really think that one versus the other is going to be different in the current market. Where I do think there would be a difference in the current market is doing a yield play versus a value add or a new development. So, the risk that comes in, let's break this down just a little bit. When we're talking about value add, we're talking about buying a property, making improvements to that property that's going to hopefully increase your income, possibly lower your expenses, so that the net operating income, the NOI on the property, is increased, and that's going to increase the value on the property. So with value add, we're going to make these changes, and that we'll be able to hopefully charge more for rent, let's say. In the next 12 to 24 months, if we hit a recession, raising rents might not be the best thing, might not be able to be achieved, but what we have seen over the past 12 to 24 months is an incredible increase in rent. Rent growth has been off the charts in, I think, every market that I keep an eye on in the US has had incredible rent growth. So even if that rent maybe stagnates or takes a little bit of dip in the next 12 to 24 months, like we said, where there's this sort of period of time where things might be a little dicey, I do think that coming out of that, we will be fine. And that's what we saw during COVID. We saw rent stagnation, or maybe a little bit of dip in rents, but then we saw this huge spike after the pandemic essentially ended. So that's my feelings on value add. For new construction, if you're starting something now, let's say you're breaking ground on something tomorrow, you're probably looking at 24 months before your building is built and you have a certificate of occupancy and people are moving in. Maybe 18 months, just depends on what you're building, could be longer than 24. So I don't think that new development that's starting now is going to be impacted by much. If you're just doing a yield play, maybe a little bit of concern, but the bigger concern I have right now is for people who bought properties with floating rate debt in the past 3 years, and who maybe have to do something with their rates or have to buy new rate caps right now. In the next 12 to 24 months, if you have to buy a new rate cap or you have to renegotiate your debt to some extent, it might be a little tough. I'm going to move on to the next question, but that was a great question. Thank you for asking it. So the next one says, which market do you see leading the charge for growth over the next 12 months? I don't know where we're going to see who's going to be leading the charge in the next 12 months. If I had to guess, we've seen some really great leaders in both Arizona and the Texas markets. So those could possibly be them. There's also a number of other areas that have seen phenomenal growth. I tend to not try to predict that. I don't even know if we're going to see a lot of growth over the next 12 months. I think maybe 12 months from now, we're going to be looking at everything and seeing it has stagnated or maybe declined a little bit just because of the environment that we're going into. I think that that's very possible. So that's my thought. The next question is, do you think the change in the House from Dems to Republicans will have a significant change, and if so, how? So yeah, politics are big, and if we see changes happening with our government, that often does affect things that, the Fed is supposed to be, bipartisan and not influenced by politics. And I don't know enough about Washington politics to talk in depth about that, but what I've heard anecdotally is that they can be influenced by the government to some extent or another. So that could be interesting. What happened in 2017 when Trump was in office and the Republicans controlled Congress, there was new tax reform, right? And with the Democrats losing the House, they're not going to be able to control policy. You've got Republicans in the House, but I don't know what's going to happen in terms of policy. I think with a divided government that we seem to have right now, I think that we're not going to get much done in terms of policy. I think there's going to be a lot of fighting, but things that have bipartisan support, which unfortunately, I'll just get on my soapbox for a second. I wish that more Democrats and Republicans could get together on issues and work through them instead of demonizing everybody. But that's just my own viewpoint on it all. I think that where there is bipartisan support, we might see some things going through. I'll give you an example. There's a new legislature that's out both in the House and in the Senate that is a change to the opportunity zone rules. It's actually really beneficial for investors and would help spur more economic development in these areas that need it, which I really like. I feel, those of you who know me, I like to leave the world a little bit better than I found it, and putting money into these areas that need job growth and is, I think, a really wonderful thing for us to do with our investment dollars. So there's these new opportunity zone change that has like good bipartisan support. So maybe things like that will go through, but any sort of sweeping tax reform or anything of that nature, I think is going to have to wait. I just don't see anything happening without, you need the support of both parties. And if the Republicans were to come up with something and it were to pass the House, would it pass the Senate? And even if it did, the president has to sign it into law. So I don't think there's going to be any big changes until after the next election cycle. When there might be more of a majority in one area or another. Another question that we have here is, what are the 3 things you wished you knew before you started your journey as a syndicator? My goodness, there's so many things that I wish I knew that I actually wrote a book about it. But the top 3 things that I wished I knew. Well, I mean, I wished I had known about syndication. I didn't even realize that I could take my money and invest it with other people who knew what they were doing and invest in these larger things. I thought I had to be, a big institutional player or have millions and millions of dollars. So when I first started off my journey, I started investing passively in deals as a limited partner. And I still do that to this day. 2/3 of my portfolio are deals that I'm a limited partner in. So I wish I had known that once I started on the journey. I guess I wish I would have known. It would have been really great to know where interest rates were going to go over time and where we'd be now, right? But it'd be great to build a time machine. But in terms of other things I wish I knew, I don't know if I can really think of anything. I mean, there's been so much that I learned, but I didn't know that I didn't know it. I learned things as I went through the process, and everything has sort of been a building block leading to the next step, leading to the next and the next. And so that's good. I mean, I would say that the question says, your journey as a syndicator. What I didn't realize is how long it would take for me to be able to really establish myself. I thought I'd have a deal or two, within a year. And, it took me 2 years to get my first deal. It took me a year to get my second deal, but it's all been, I think, good and a very positive thing. And I have one question left. If anyone else wants to do another question, I can take one more question if anyone wants to put one in. But this may be the last question for tonight. So this says the 10-year Treasury has fallen almost 50 basis points in the past 2 weeks to below 4%. we've got a loan to either rate lock at a higher, we've got a loan to either rate lock at a higher rate or do a swap lock in the next 30 to 60 days. Think the 10-year will come back up over 4 soon? Oh man, that's a crystal ball question. Basically he's saying we can either lock our rate right now and that treasury rate. So I talked about SOFR earlier. So a lot of floating rate debt is based off of SOFR, and a lot of agency debt and other debt can be based off of the 10-year treasury, which is why I used both of those actually in some of the examples tonight. So it sounds like this person, their interest rate is going to be based off of the 10-year treasury. What happened a couple weeks ago, almost 2 weeks ago, is that the reports came in, unemployment ticked up a little bit. And we also saw inflation tick down a little bit. Now, not enough for the Fed to stop doing the interest rate hikes, but those positive movements, I think, caused the Treasury to go down. And so is it going to go up in the next 30 to 60 days? I don't know. It's pretty low right now. Maybe you lock in and just, stick with it. I don't know that I see them going down another 50 basis points in the next 30 to 60 days. A big decision is going to be what the Fed does in December, with interest rates. I think the market right now is pricing in a 50 basis point interest rate hike. If it were to be different, that could affect the 10-year treasury, or a lot of times they hit what they said, but they make a statement, and the statement is more forward looking. And if they say, if the Fed Chairman Powell were to go up there and say, we think we're going to need to continue very strong tightening measures for the foreseeable future, or something like that, then the treasury might go up. I don't feel comfortable answering this question and putting your loan rate in my hands. But if it were me, I would probably lock in right now. Personally, this is not advice. I'm just saying, like, that's what I might do. But we don't know what's going to happen. I think what's going to be interesting is over the next 3 to 6 months, if we continue to see unemployment go up, start to get maybe past 4% and continue upwards. If we see inflation go down, if it gets down below 7% and maybe continues down lower and lower, I think we will see the Fed continuing to ease off. And I think we will be coming to a little bit more of an equilibrium with interest rates. But right now, things are just kind of in a state of flux because data is coming in rapidly and markets are shifting quickly. So if there's any more questions, you got about 5 seconds to type something in. Otherwise, listen, I just want to thank everyone for coming tonight. I hope that maybe you learned a couple of things, maybe got some insight on maybe how things are going to go. Everyone realized this was not advice. This was just me kind of talking about things and just kind of an educational sharing of some previous data points. And if you have any questions about the real estate market or want to talk about anything online, I'm always available. You can always send an email and go ahead and reach out. But until we speak again, thank you and have a good night. And thanks for attending. Bye, everyone.